So in this video we're going to look at fiscal and mainly monetary policy within a global context and also look at external shocks. So first of all, if we look at monetary policy, central banks within a global context particularly have a problem with controlling the money supply within a country. First of all, because banks can create credit through the money multiplier process, and therefore it's hard to limit that. But even if you succeed in controlling banks, what about the shadow banking sector? So there's financial institutions that behave like banks but can also create credit. And particularly in a global context, when there are no capital controls and currency controls, and hot money can flow in and out of countries, and therefore it's nigh impossible to strictly control the money supply. In any case, the idea that the money supply necessarily directly influences inflation, which is the monetarist idea, is certainly questioned. See the video on monetarism for that. So that's one problem in the global context. A problem with fiscal policy is how high can income tax be on top earners. So in the UK, it goes 20%, 40%, and up to 45%. There was a 50% rate not so long ago. But the rates of the 70s heading to 83%, or even 98% on earned income, could result in significant brain drain migration loss, when the top rates are much lower in other countries. So in other words, governments within a global context, where a global elite are relatively footloose, can move from country to country to an extent depending on the top rate of income tax. And certainly capital can be moved around the world to lower tax economies, and this is a particular case, of course, with corporation tax, as we can see in the video that explains how corporations avoid higher rates of corporation tax. So governments have found it more difficult from large corporations such as TNCs to collect corporation tax. Some economists argue that it's increasingly difficult tax to collect on a global context, and maybe should be reduced or just given up upon. And similarly, if you want to pursue a social democratic policy of a progressive tax system with higher rates of income tax, maybe globalization limits the extent to which you can do this. Now, if we look at global shocks, if global interest rates were to increase, for example, then to prevent the pound falling, the central bank would need to follow that trend and increase interest rates. And we can see that, for example, on Black Wednesday, when the UK government had to follow the German government in increasing its interest rate to maintain the value of the pound within the exchange rate mechanism. Now, you might be happy for the pound to fall, but that is a factor. And if we look at external shocks, within a globalized economy, governments and countries are more subject to perhaps more frequent and larger global shocks, be they demand-side shocks or supply-side shocks. So just to look at an example, if we have a big commodity price increase, say a big oil price increase, then this tends to cause cost-push inflation. As illustrated in this diagram, if we start at point A, okay, suddenly we have an increase in oil prices or other commodities that are significant, and that shifts short-run average supply suddenly to the left. So this imposes an exogenous, an external negative supply-side shock on an economy such as the UK. So how does the government respond? So you could either, or how do policymakers respond? Because you could either go to try and maintain a lower, get back to your previous rate of inflation. Yeah. So if you're particularly keen on maintaining the price level at P1, then what you may do, of course, is to tighten fiscal or certainly tighten monetary policy, and that shift aggregate demand from AD1 to AD2, and in that way you go back to your previous rate of inflation at P1, basically. But what happens is already you've got a contraction in the economy, and you have a further contraction to Y3. So there's a recessionary effect, and you've made this deeper by tightening your fiscal or monetary policy, or perhaps both. So you go from A to B and then to C. Or another alternative isn't a policy of accommodation. You accept that inflation's going to go, but you're concerned about economic growth and unemployment. So what you do is you actually reflate the economy, okay, and shift aggregate demand to the right instead of the left, and go, say, we go from A to B, we end up with B, and then you reflate and you end up at D. Fine, but of course this is going to inject yet more inflation into the system. So you can see that a negative external supply side shock is quite damaging for an economy. This happened to the UK in the early 2010s when commodity prices started to increase and inflation headed towards 5%, it was 5.2% at its peak. So we start off at Y1, and if we give up on inflation, okay, we can get back to Y1, yeah, but with a much higher rate of inflation at P3. Because the danger is once you end up with more inflation in the system, you end up with wage push inflation, and you could get a wage price spiral taking off, something central banks are generally concerned about. So this is an example of an external shock. You could have an external demand side shock, which occurred, of course, in the financial crisis of 2008, where countries were buffeted by a global demand side shock as a result of the financial crisis, and banks restricted their lending, and of course that resulted in a fall in consumption and investment throughout the world. This shifted aggregate demand to the left very considerably, causing a rise in unemployment, causing a severe recession. How do you respond to this? So you either respond in a Keynesian way by boosting aggregate demand and heading back towards where we were, as illustrated by this simple Keynesian diagram here, okay? Or some governments got into fiscal difficulties and therefore introduced higher taxes or cuts in government expenditure, thus exacerbating the recession. This is just a brief summary then of fiscal monetary policy within the global context and some of the policy dilemmas that inevitably arise. So thank you very much for watching.